Okay, hi everyone, back with another video. And in the last few videos, we were focusing on activity-based costing as well as standard costing. And hopefully you found those two videos, or the four videos, much informative. And yeah, like I said, you can always drop a comment and I'll answer it to you as best as I can. So now we're going to focus on cost, volume, and profit analysis, right? And this is where we're analyzing the relationship between cost, volume, and profit. It's in the name, right? So essentially what we're saying is we're going to have selling price times the quantity produced, right? So Q produced, and then we're going to say minus variable costs and times the quantity produced. And normally this is where we analyze break-even points. That's what we're looking for. And then we have fixed costs, and that should give us operating income, right? And now with operating income, that's like basically the income or profit that we have essentially before other costs like your marketing, indirect overheads. No, not indirect overheads, but non-manufacturing costs. So this is everything post-production. This is based on post-production, right? So we can say it's technically our gross profit in a nutshell, right? Because gross profit is income, but not necessarily like after our bad debts and so on and so forth, right? So break-even point. So break-even point, which is BEP, is essentially our selling price times our quantity produced or sold, whichever one. They work interchangeably, but it should be produced. And then V, variable costs times the quantity produced. And that less the fixed costs should give us 0. So technically we are saying, and if you know anything about break-even point, this would be the contribution. Okay, I'm kind of sort of jumping the gun. So essentially that's why we have fixed costs over contribution. Contribution. And then whatever this is, so X times quantity gives us amount. And therefore this amount technically is equal to the fixed cost, hence it's 0. So break-even point essentially is how much do we need to produce in order to meet all our fixed costs, hence this formula here. So this is our contribution and this is our fixed cost. And essentially this is where the whole formula comes in. Technically this is this. Okay, but let's not jump the gun. Let's see. So now we have total revenues is equivalent to total cost, like I said. So we want our total revenues to essentially be equal to our total costs. And then contribution is essentially equal to our fixed costs, right? And now unit break-even point. So our unit break-even point is technically equals to the total fixed costs over our total contribution. Right, and then we also have this new thing in third year. And in third year, we learned of the revenue break-even point. So revenue break-even point is equals to the total fixed cost right over total contribution times total sales. So the information is what will lead you to actually determine which one to use. If we're focused on units produced, everything is given based on the units, then you know that you're going to use the unit break-even point. But if everything is focused on the revenue and the total contribution in rand amount, then you know you're going to focus on the total sales. And then, so yeah, essentially this is when no unit information is given. Information is given. Okay. And then we also have the last one called the contribution margin, which is technically another version of the revenue break-even point. So the contribution margin, and my Manfin teacher lecturer always says that anything margin, just know it's in relation to sales. And yeah, it's been a life changer. Contribution margin is always a percentage as well. And that is our total fixed costs. Costs over to contribution percentage, basically. Now, as you can see, it's technically always the same thing. Fixed costs over contribution, and so on and so forth. And in order to get this one, this is basically contribution. And remember, margin is always over sales, so it's the selling price. Selling price. I wanted to say SP, but I didn't want to confuse you. Times 100, because we want the margin. And that's how we get the break-even point based on the contribution margin. And it's also similar to revenue break-even point. Oh. So this one is like the least favored one, least tested, least likely, but it does pop up like a ghost sometimes. Okay. And yeah, for after tax, you know, it's always after tax effects. We're gonna have the 1 minus t. That's it, always numerator and denominator. Doesn't really matter. And that's it, everyone. Now we're gonna have focus on this term called the target operating income. So target operating income, like I said, operating income is when we have our sales less fixed and variable costs, essentially our gross profit. But we say it's target because it's something that we plan for. It's something that we actually want for us to essentially know that we are making a profit. And with a target operating income, right, we're gonna have the unit break-even point as mentioned above. So we're gonna have our unit beep, and that is basically always after tax, right? So contribution will be our denominator, contribution per unit, obviously, and it's less tax, and over total fixed costs, and it's also less tax, which is something that I said above. And essentially everything will give us 0. Therefore, our target net income, which is after tax, is basically target net income. So this net means after tax is our total, is our target, target operating income less tax. So tax. Okay. And yeah, that's all you need to know. Most of the time when it comes to target operating income, we're going to focus on the unit break-even point, and it has to be after tax. So whatever our fixed costs are, after tax. So currently our tax is 27%, so it will be the total fixed cost times 73%, total contribution times 73% to get that, and then we get our unit break even. And then in order to get our target net income, we get our target operating less tax as well. Yeah. So now remember, our target operating is our selling price less variable costs less fixed costs, and we get our operating, and same as target. Okay, and now we're going to focus on the sensitivity analysis and uncertainty. So sensitivity analysis and uncertainty. I think I'll make a separate part for this part.